All right, let's talk about something that's important to us, and that's the retirement minimum distributions, or RMDs. This is a fundamental concept for anyone with tax deferred retirement accounts. Well, what are they? They are mandatory withdrawals that you must start taking from your retirement account once you reach a certain age. Now, why do they exist? Well, the reason is simple. The government gave you a tax break for many years, allowing your money to grow tax deferred. Now the government wants to get that money back, and that's how they're going to get it through your RMDs. We need to know which of our accounts are subject to RMDs. The most common tax deferred accounts that require RMDs are traditional IRAs. And then of course, we have the employer sponsored plans that were tax deferred. And that's 401ks, 403bs, 457bs, and there are some others. However, there is one crucial exception that I want to highlight that's exempt from RMDs, and that's Roth IRAs. They do not require RMDs for the original account owner. This is a huge benefit of an Roth IRA, and it gives you more control and flexibility in your retirement years. And we'll talk about that later. But for now, we need to know which accounts count. And also, we need to know that it's worth noting that if you're still working for a company, you may be able to delay your RMDs from that specific company's 401k plan until you retire. As we discussed, required minimum distributions are a key part of retirement planning, but at the age at which they begin isn't the same for everyone. It depends on your birth year. I would like to walk you through the current 2025 rules so you know exactly where you stand. For those who are born before July 1st, 1949, your RMD started at the age of 70 and a half. Now, if you're already in that group and it's 2025 or later, you should already begin or already be taking your RMDs. The next group is if you're born between 49 and 50. Here the RMDs was 72 years old. And again, in 2025 or later, you'll be taking your RMDs. Now we got a big group of people, and this is where born between age 51 and 59, and your retirement age is now 73. This is good news as it gives you extra year to let your money continue to grow tax defer before you must start taking your withdrawals. And now for those who are going to be born in 1960 or later, your RMDs is going to be a whopping, you don't have to take it until age 75. Now, the main takeaway here is that your RMDs start age isn't a single number. It's a specific number to your birth year. Knowing your correct start date or age is the first step of managing your retirement accounts and avoiding costly penalties. Now let's talk about how RMDs is calculated. It's a pretty straightforward formula. Most financial firms will calculate this for you, but it's useful to understand the basics. There are two parts to the calculations. One, the account balance. Your RMD for the year is based on the account balance of the previous year, December 31st of that year. For an example, For year 2025 RMDs, it's going to be based on the account balance on December 31st, 2024. Now, part two is the life expectancy factor. The IRS provides a table called the Uniform Lifetime Table, which gives you a factor based on your age. And let's go through a little example here. The formula is simple. The RMD equals the previous year's balance divided by the life expectancy factor. So for an example, if you're 73 years old and you have a $500,000 IRA, you will use a factor for this age that's from the table. And as we'll see, that factor is 26.5. So you divide 26.5 into 500,000 and you must withdraw 18,868. Let's go over this a little more in detail in the next slide. The IRS provides the life expectancy tables to help you calculate your RMDs, required minimum distributions. The most commonly used table is the Uniform Lifetime Table. This table gives you specific factors based on your age, which you will use in your RMD formula that we will go into the next slide in detail, to determine how much you must withdraw from your tax-deferred retirement accounts. Let's look at this table over here. Here's the table. So as we said in the previous slide, looking at that, if you're age 73, your distribution period, also called your lifetime distribution, is 26.5. And as you get older, you can see this distribution factor does decrease, which means your amount you're going to have to pay will increase. Now we know when we need to take an RMD. Let's look in more detail at how you calculate this amount. The first piece you need is your previous year's account balance. This is the total value of your retirement account, your tax-deferred retirement accounts on December 31st of the previous year. For an example, to calculate your RMD for 2025, you will use the balance from your account on December 31st, 2024. Your financial institution will provide this information to you. Then the second part is we need the life expectancy factor, also called the distribution factor. The IRS provides a table for that. You can see here's a formula that we'll be using. You get the previous year balance and divide it by this life expectancy factor. And this, of course, is based on your age. So we got the previous balance, and let's look at this table from the Uniform Lifetime Table. And this is the table taken straight from the IRS. And you can see we looked at this already, but we can see the different ages. And let's do that example again. So if we have 500,000 and we were 73 years old, you divide 500,000 by 26.5. And here we go right here. We can see that. And you'll get to 18,868. So this is how much you will have to pay in your RMDs. Now, of course, if you have more money or less money, that's going to change. Now, if we were doing this at age 74, we now will not use 26.5. We will use 25.5, and that would increase this amount here. All right, I cannot stress this enough. The penalty for missing an RMD is severe and something you should absolutely want to avoid. the penalty is a significant 25% of the amount that you should have been withdrawn from your account. This penalty is on top of the regular taxes you will have to pay on that withdrawal. Let's give you an example. Let's say if your RMD for this year was $20,000 and you completely forgot to take it, you would then owe $5,000 penalty for the IRS. And then on top of that, you got to pay tax on the $20,000 because it's a distribution from your IRA. This is a huge financial hit for something that's completely avoidable. So make sure you know your RMD amounts and have a plan to take it out each year. Set up a reminder, or even better yet, make an automatic withdrawal so you don't have to worry about it. It's a simple step that can save you from a major financial headache. And we just want to know there is a little exception here. It's a good one, I guess. For your first year, your first RMD is extended to April 1st of the next year. But then that year, you need to pay 2 RMDs for the previous year and the current year. So it's best to take it each year, but it's good to know that.